Welcome back to Rich Dad StockCast. I'm your host, Denney, and today we're talking about something that scares most investors, and that's the next market crisis. If you've invested long enough, you know one thing is certain. There will be another downturn. Nobody knows exactly when, but history tells us it will come. And while most people see market crashes as something to fear, the world's greatest investors often see them as some of the biggest wealth-building opportunities of their lifetime. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." And in Andy Tanner's more than 25 years of teaching investors, he's watched that exact cycle repeat itself over and over again. The dot-com crash, the subprime mortgage crash, the COVID crash, the Silicon Valley banking collapse, wars and geopolitical conflicts around the world. Every crisis, well, it looked different, but investor behavior was almost always the same. So today we're talking about how smart investors prepare before the next crisis and how volatility can become an opportunity instead of a disaster. And before we get into it, make sure you go to stockcastbonus.com. Grab your free investing tools. If you want to be prepared instead of surprised, that's where you start. Andy, welcome back.
This is such a great topic, Del, and our approach to it is maybe different than people think. I think this will be one of the best podcasts. People are going to love this one. This is really going to be valuable.
I couldn't agree more. I've been waiting all week for this. Now, before we get into it, stockcastbonus.com, great resources for preparation, for education, always adding to it. What do our listeners receive when they go there?
Hey, you got stuff with your name on it, and you got stuff at no charge. We provide webinars that are free, tools that are download, things that I use, trading journals. You can see how we do it personally. We have ebooks. There's a lot of cool stuff there, a lot of free resources, and it's a great way, if you like what we do, it's a great way to get to know us better and to learn more and more often, and really important, better action taking. Especially some of the ebooks we download have regimens, recipes, things you can follow to increase your cash flow. So great value always at stockcastbonus.com.
Fantastic. I love it. All right. So Andy, you've been teaching for more than 25 years. You've seen about every crash in there. I know it sounds weird to say we've known each other for 20 years. So we've together seen a few crashes through the years. Now it's the whole geopolitical thing happening in the Middle East, right? What's the biggest lesson you've learned watching investors go through these cycles?
Wow, the biggest lesson. Well, it's not a new lesson, so it's probably not exciting, but it takes experience. It takes a little bit of stomach. I shouldn't say stomach. It takes temperament is really what it is. Warren Buffett said this. He said, if you really want to be good, sell some of your IQ points and instead focus on your temperament. And in a crash, I don't think there's anything more important than just being relaxed, keeping your head and seeing what's going on. Probably one of the most quoted quotes, most oft-quoted quotes from Buffett. And I have this posted in my office. I mean, I have a sign that reminds me of this every day. I have it up on the wall. He says, "I will tell you how to become rich." And very simple. I will tell you how to become rich. Close the doors. It's a secret. Close the doors. I will tell you how to become rich. Close the doors. Be fearful when people are greedy, and be greedy when people are fearful. And that doesn't just mean broadly in the market. That means when you meet someone individually or in an individual stock. It doesn't need to be a systemic crash. But having the temperament to understand that, it doesn't necessarily mean being a contrarian. It just means have a temperament to look at things as they are. And we can really unpack that in this podcast. But I would say that the number one thing is temperament. And then I would say the number two thing right underneath it, got to have a little education. Got to know what you're doing. So if you can combine those two things, is keeping your head and knowing what you're doing, that 1-2 punch, I believe Warren Buffett is right. And I am so grateful, particularly in COVID, because as you get older and you've been through a few crashes, you just get wiser to it, and your temperament improves, and you have more. I had more knowledge in COVID and more experience than I did in the subprime meltdown. I had more experience going to the subprime meltdown than I did in the dot-com bust, and I had more experience going to the dot-com bust than I did in the mutual fund problem when we, back in the 80s when I was, just getting out of high school and had no experience. So you had, every single time you have one of these big ones it's on sale. And the bargains, Buffett calls it shooting fish in a barrel. If you read his 2021 letter after COVID, the 2021 letter to Berkshire, he says that shooting fish in a barrel experience rarely occurs in Marseille. Meaning, and it doesn't recur outside of, where you would negotiate outside of the marketable securities. So the panic in the market is a blessing to us because it puts things on sale. And as you mentioned in the open, that mentality is the same every time. Wall Street doesn't change. It's they're Pavlovian dogs. They're predictable in how they'll react. It's glorious.
Now, we probably, speaking of Pavlov's dog, now with experience, when crisis happens, we might salivate a little bit, right? Now, to put that in practical terms, I want to touch a little bit more on that idea of being fearful when others are greedy. To the average person getting into the market, seeing the news, it's scary, and you want to go with the sheep. The sky is falling. But that temperament that you said is so important because you realize everything is on sale. So how do we look at it with that lens? How can we get excited?
So the other thing I would say is we had two concepts. Number one was a temperament issue and an education. Keeping your head and having a head, knowing what to do, right? Having a noggin that knows what's going on. But I would say the third is your approach. And my approach to crashes is different than even many of my mentors. Because even many of my mentors, I've watched them make mistakes as much as I've learned from them. And I think one of the mistakes people have is in context. Is their context is not the best. So I'm going to back up and explain two different contexts. The first context, which I think is the one that is unwise, and I could be wrong on this, by the way. This is Andy's opinion after doing this 30 years, but I'm learning new things every day, so I could be dead wrong on this. But I think the worst context you can have is prediction, where I'm trying to find out when the crash is going to be. I'm going to look at it and I'm going to say, we're going to have a crash this year, and I'm going to position myself to make money on this crash. That's gambling. That's like going to the casino and saying, we haven't hit red for a while. We have a lot of black on the roulette table, 3 in a row. I'm going to go with red. When you place a bet, you're gambling. When you make a prediction, you're gambling. What I like better, and I think this logically can make sense to people, I like a context of preparation. So let's look at it this way. How does a real estate, as a holder of real estate, how do I deal with fire, right? I mean, if I live in California, I don't know when, right? I don't know if it's going to be my house. I don't know if it's there tomorrow, probably in the summer, but maybe not guaranteed. So what we do is we don't predict what day we're going to have a fire and then sell our house before the fire is going to hit. Does that make sense? Mm-hmm. Like I wouldn't go and say, think the value of my house is going to go down. I think the fire is going to be next week. I'll put it up for sale today, sell it, take the money, and then I'll avoid getting hurt when it dies. I mean, to me, that makes no sense. I think it's very hard to do, and yet that's what people try to do in stocks and real estate. Let's sell at the height of the market before the fire starts, and we get hurt by the fire. A better approach in context is to say, you know what? Let's prepare every day for a crash. Let's be prepared every day. Let's be ready every day. And I think you prepare in 3 or 4 ways. Number one is insurance. When Robert wrote this book, The Unfair Advantage, he asked me to write a section on stocks, and he said, Andy, what's the difference between a professional and an amateur from your point of view? I said, it's how they get their money and how they manage risk. They tend to make their money in capital gain, where professional investors care more about what Buffett would call operational earnings or cash flow. And they diversify out of risk or try to predict risk rather than to insure it. And professional investors use contracts, which is all an insurance policy is. It's a contract. My house burns down. I pay you a premium. House burns down. I get a windfall. And I think insuring it, we call this hedging, not like hedge fund, but we call this a hedge, which is a defense. A hedge is like a moat around the castle. It's a hedge. Shakespeare's the first person that used it that way, to lurch offensively or to hedge defensively, to lurch or to hedge, meaning you have a hawthorn bush that is protecting you at all times. So I really like the idea of preparation. Now, that doesn't mean that I will not look at the weather to say, gee, it's pretty dry out, right? It's pretty dry. Ooh, there's a lightning storm. Time to really make sure and double check everything, right? Looks like we're going to have rain in the forecast. Probably make sure we have our umbrella ready. We'll still have our picnic, but let's have the umbrella ready, just in case. And I think there's some things you and I could talk about that let people know it's still wise in this euphoria of this incredible AI speculation. I'm all in. I think AI is going to be incredible for business. I think these multiples are historic because we live in a historic time. I think they're expensive because I think they might be more valuable than ever from a growth standpoint. And so we can delve into those details if you'd like in this podcast or another. Maybe we do it like Batman and say, stay tuned. But I would say in the first half, you usually do podcasts in halves, is the three things to take away from the first half of this conversation are, I have to have a proper temperament because crash will come. I may be predicting one, I may not be predicting one, whatever, but it will come. They do come. It's just a cycle. They just the emotions of it make it happen, and that's just how life is. We're going to have another one. When? Who knows? But we'll have one. So being prepared for the earthquake, being prepared for the fire, even if your house never burned down, you would not be wise to bet on not having a fire in your home. You'd be wise to bet on insurance and have it just in case because too much is at stake. So temperament, number one, education, number two, and then the context of saying I'm going to prepare rather than predict. I think that's a great little trifecta to take away from this so far.
That's awesome. Well, let's do this. Let's take a quick break. Listener, if another crisis is inevitable, then maybe the better question isn't if it's going to happen, but it's how prepared will you be when it does. So when we come back, Andy's going to explain how professional investors prepare long before the headlines and how they position themselves, how to protect capital while looking for opportunity. And don't forget, go to stockcastbonus.com, download your free investing resources. That's where you'll learn the skills that help investors stay confident during uncertain markets. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad StockCast. All right, Andy. So let's talk preparation. How do we get prepared so that if another correction is eventually coming or a crisis, what should investors be doing today?
So it's a little bit different when you're looking at what we call a black swan event, which to me is just a Black Friday for investors. It just really is. So let me share some insights it's very difficult to take 20 years of learning in the second half of a podcast. So I hope people will be patient with me there. It was really funny. I had one of my guys on our other channel do just this incredible video, 80,000 views or whatever it was. And there was a comment by a guy says, well, you didn't talk about this. I'm like, that's like coming over to my house for dinner and I have a smorgasbord and they say, well, you had turkey and you had chicken and you had ham and you had beef and you had pulled pork and ribs, but you didn't have a rack of lamb. So it's very difficult to give all the food in one meal here. So hopefully that says more about that guy than Corey and Noah who did the video. Okay, first thing is when you see a crash, how do you know when the bottom is? How do you know when it's on sale? And the answer is I don't know the bottom. I do not know the bottom in a crash. But what I can do is understand the fundamentals of the company. So let me give you some great companies. I'll give you an example you mentioned Silicon Valley Bank. So let me give you an example we did with my son. And I'll show a triple-digit return for my kid over a couple of years here. Okay, 3 years, triple digits. So here we go. Silicon Valley Bank goes under. So this isn't a crash of a market, it's a crash of a business. That's an opportunity, right? The way it happened, and hopefully this isn't too long-winded because it's a great story. So when a bank takes in deposits, that's a liability to them. They have to pay interest on those savings deposits. So let's say Silicon Valley Bank takes in $1 million from somebody. They got $1 million in the bank. That's $1 million they got to pay interest on, and that they owe somebody. So that's a liability to them. So they have to figure out some type of arbitrage. They got to say, all right, let's take this $1 million that we're paying, 1% on, and let's find an asset that pays 2% or more and buy it, and then we're making money, right? We get that spread. So generally what banks do is they'll take in savings and pay, 0.5%, 1% back in the low interest days. Now it's much more. And then they loan it out in real estate. So let's say they're paying 1% and charging 4%, right? And they have to see who is worthy of loaning that money to. And so that's great. Well, Silicon Valley Bank was not in the real estate business. They didn't do mortgages. They were more about venture capital, VC. So they would take savings deposits and they would say, what's a great venture to fund? VC, because that's higher risk, but it's huge return. If I can take that $1 million that you're saving with me and I can loan it to Entrepreneur Johnson over here, I can make a lot of money that way. But I have to be more careful and selective. So they would have a lot of deposits that didn't have a home, that didn't have an investment on the other side of the liability. So they'd buy treasuries, and they'd say, look, the treasuries are paying, let's say, 1.5, the savings account's paying 0.5. Great. So they take the money, they buy treasuries, which is, interesting because the deposit guy wants the money accessible, but treasuries are liquid anyway. I mean, it's just how it is. COVID hits and we go inflation through the roof. Biden prints, 1.9 or $1.7 trillion. We flood the market with cash, helicopter money, people getting checks. This isn't like 2008 where they just gave it to the institution. The institutions gave it back to the Fed, never got in circulation. This is money that's spendable cash so people can pay their rents, right? And the mortgage and the landlords don't die. So this was helicopter money in every sense of the word. We have double-digit inflation. So what does the Fed have to do? Raise rates. Well, that puts Silicon Valley Bank in a crappy position because now their bonds are paying 1.5, 2, and the new bonds are paying 6 or 7 or whatever it was, right? So if they wanted to sell their bond, why would I buy a bond from Silicon Valley Bank that's paying 2 and I can get a nice new fresh one at 6? You'd never do it. So that means Silicon Valley Bank would have to sell their bonds at a discount. Well, if you remember A Wonderful Life, Jimmy Stewart, where he's going on the honeymoon with Mary and he's got his money and they're going to go have fun, and Ernie the taxi cab driver says, hey, I've never seen one. That's got the earmarks of the run on the bank. So he goes to savings and loan, the old Bailey building and loan, and he's got all these people wanting their money. He says, it's not here. I took your money and I loaned it out to this guy to build a house. I don't have the money. That's where Silicon Valley Bank was. A bunch of guys looked at it and says, you know what? Let's have some fun. Let's pull our money out. They really did. A bunch of rich guys said, let's pull our money out. So they go to Silicon Valley Bank, say, I want my money. And Silicon Valley Bank says, well, it's all in treasury. So they go, great, liquidate the treasury. Give me my money. Well, I can't liquidate the treasury because mine's paying 1 and the new ones are paying 6. I got to sell a discount. 24 hours, they die. So that creates contagion. And in the entire banking sector, people are like, well, how many other banks are in this situation? Because they all have the same problem. They've got deposits and they've got to have treasuries. And, what's the stress test there? So the banking sector, if you look at that financial ETF, it's just dying. That sector ETF is dying. And I said, sons, both my kids, I said, sons, let's go shopping. So one of the banks we looked at was Citigroup. Now, let me show you. It bottomed out in the 30s. I think David is the one I got in mind. He bought it at 45. I think today it's, what is it, 120? I don't know what it is. Probably tripled, something like that. So let's see, 40, 80, 120, whatever it is. So we looked at this, and we looked at this metric called price to tangible book. And this works better in banks than in others. It's a fundamental number. And it really means this: what do you buy? So if you bought my estate, Dell, let's say you buy everything I've got, you would say, I'm going to take on Andy's liabilities and Andy's assets. What's the book value of Andy, if you were to buy him? And if you cut up my life into shares, you'd say, well, what's the price per book value, right? How much am I getting? Well, the book value price to book was 50 cents. 50 cents. What that means is for every 50 cents you spend on a share, you're getting $1 of value on their balance sheet. 50 cents on the dollar, just like old man Potter said. I'll give you 50 cents on the dollar. Remember that?
Yeah.
We're literally paying 50 cents for $1 of balance sheet. So I didn't know how far it would go. I didn't know how bad it would get. It actually got down to the 30s, and that would have been great if I had a crystal ball. But as that price began to fall from the 50s or high 50s, once it hit about $45, I'm like, man, that's 50 cents on the dollar. That's a good enough deal. I don't need to get the bottom. That's a good enough deal. That was in March-ish, March-ish, May-ish, probably spring of 23. I think that happened. And today, and he just did 100 shares. That's it. He had $4,000 in, lemonade money and odd jobs money, working around. And he put in, he had more than that, but he put in he bought 100 shares for $4,500 as cost basis. So now that I think that's probably worth probably $13,000 for him right now. So that's a $9,000 gain for my kid on 100 shares. Why? Because when everyone else was fearful, he had 3 things. Number 1, he was prepared. He had some cash ready to go, right? He was prepared. He wasn't predicting. He was prepared. Number 2, he had the temperament with a little help from Dad saying, this is a sale. This is 50 cents on the dollar. This is a sale off everyone else's emotions, right? And then 3rd, he had the knowledge of how to go out and get it, and then you write covered calls on it and, cash flow it, and it's a pretty cool asset for that little stinker. And he's a high school kid, for heck's sakes. And I'm proud of him for it, I think it's great. So that's an illustration of being prepared by having a little cash, having knowledge of how to do that fundamental analysis, and having the temperament to pull the trigger. And I've had stuff like that in my life. It's been life-changing for me because I have more money than my kid. And there's just certain assets. it makes me feel good to have them inherit this stuff because they are all about financial education. They won't squander it. They'll build it, and they'll probably be better than I ever was. They'll probably learn more and learn earlier. And I'm bullish on those kids. But that's an illustration of buying in a crash and how I didn't know the bottom, but I did know when it became valuable. When it's 50 cents on the dollar, that's a pretty good bet.
That's a phenomenal bet. That's amazing right there. Now, listeners are probably thinking, that's awesome. I would love to learn these three things. So as we wrap up, my last question is, if someone wanted to learn those three things, they wanted a better temperament, they wanted better knowledge and education, what do they do this week? Where do they go? What can they learn? Where can they learn all this?
Two things I think we should do. I think we should do another episode like this. I think we should say, we'll come up with a name with it right now, and let's just say, preparing for the crash part 2 or whatever we call it. So the second is stay tuned because I have more to share on this. It's too important. I have other ways to hedge. I have much more. Like I said, someone's going to say, well, you didn't talk about this and this and this. Well, let's talk about this and this and this. So subscribe to the YouTube channel and stay tuned for the next episode because I have more to say on this. Number 2 is go to stockcastbonus.com right now and start learning and start getting your regimen down and start learning about how much to have in cash and how to be ready. There's things you can do with less cash, things that I do that don't take a lot of cash. Certain things that are really, really, really smart insurance. Think about insurance. To insure $1 million home, you're not paying $1 million to insure $1 million home. You're paying a little bit of money to insure something big, and if the big thing collapses, your little bit of money turns into a big amount of money. Insurance is a leveraged investment, right? It's like a call option or put option. I mean, you spend a little bit of premium, and if there's a big move, you get paid big, 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 big. So there are very conservative leverages, very conservative, that I can share. So watch for those. So those two things. Stay tuned, subscribe. We'll do another episode on this. Let's just do it back to back and continue this conversation because there's so much more to do. And then also go to stockcastbonus.com and get going with us. Start learning with us like today, like right now. Change your life.
I love it. Well, thank you, Andy. Listeners, listen, history doesn't repeat itself exactly, but it does rhyme a little bit. Markets will continue to cycle. There will be periods of optimism. There'll be periods of fear. And investors who build lasting wealth aren't the ones who predict every crisis. They're the ones who prepare the best. And a huge thank you to Andy Tanner for sharing more than 2 decades of lessons from helping investors navigate some of the biggest market events of their lifetimes. But if you want to be the kind of investor who sees opportunity when others see panic, just like Andy said, go to stockcastbonus.com right now. You'll find free tools and resources designed to help you to invest with confidence in every market cycle. If you've enjoyed today's episode, make sure you like it, subscribe, especially as part 2 comes here soon. Share it with someone who gets nervous every time the market gets a little bit crazy and volatile. Thanks for listening to Rich Dad StockCast. I'm Denney. Stay smart, stay invested, and we'll see you next time.
This podcast is a presentation of Rich Dad Media Network.